Hey everyone, welcome back to the channel. The IRS just dropped the new federal income tax brackets for 2026, and trust me, this is going to affect pretty much every single one of us. These updates might sound a bit technical, but they're a huge deal for your wallet. They decide how much of your hard-earned money gets taxed at each rate, how much you actually get to keep, and even how much you can sock away in your retirement or health savings accounts. And here's a little secret most people miss. These aren't just random adjustments. They're a direct result of inflation and new rules from recent legislation. So the way we calculate our taxes next year is going to feel a little different for millions of Americans. Let's dive in and see exactly what's changed and what it means for you. Okay, let's get to the main event. The IRS has officially released the new income tax brackets for 2026. These will apply to the income you earn starting January 1st, 2026, and you'll see them when you file your taxes in early 2027. The good news is, the structure is still the same 7 tax rates, from 10% up to 37%. But here's the key. The income thresholds for each bracket have all shifted upward. This means more of your income gets taxed at the lower rates, which is a win for everyone. For single filers, the 10% bracket now covers your first $12,400 of taxable income. Now, for married couples filing jointly, the numbers are pretty much double, which is standard. You'll pay 10% on your first $24,800. The 12% rate applies up to about $100,800, 22% up to $211,400, 24% up to $403,550, 32% up to $512,450, and 35% up to about $768,700. Anything over that is taxed at 37%. For heads of household, your brackets are nestled in between those, and your standard deduction rises to a nice $24,150. So what does this actually mean for your bank account? Basically, these increases give you more breathing room. Imagine you're a single filer earning around $100,000. In 2025, you might have been getting close to the top of the 22% bracket. But now, with these new brackets, that same income keeps you comfortably within that range, saving you a bit on your total tax bill. It might not sound like a life-changing amount, but those small percentage differences can really add up. A small shift can mean a few hundred extra dollars in your pocket, and with rising costs for groceries and utilities, every bit helps. The IRS explained that these changes are designed to combat what is known as bracket creep. That's when inflation pushes your wages up. But if the tax brackets don't move with them, you could get bumped into a higher tax bracket even though your actual purchasing power hasn't increased. These adjustments help prevent that from happening. Now, let's clear up a common misconception. Being in a certain tax bracket, say 22%, doesn't mean all of your income is taxed at 22%. Our system is progressive, like filling up buckets of water. Your first bucket of income is taxed at 10%, the next bucket at 12%, and so on. That 22% rate only applies to the portion of your income that falls into that specific bracket. I get comments all the time asking, if I earn $1 more, will I lose thousands in taxes? The answer is a big, resounding nitrogen monoxide. That's not how it works. A raise is always a good thing. You'll just pay a slightly higher rate on the amount that crosses over the bracket line. Next up, let's talk about something that benefits almost everyone, the standard deduction. This is the amount you get to subtract from your income before the taxman even starts his calculations. For 2026, it's getting another boost. It's now $16,100 for single filers. This is a big deal because about 9 out of 10 taxpayers take the standard deduction instead of going through the hassle of itemizing. So these increases directly lower the taxable income for most Americans. If you're married and in the 22% bracket, that extra deduction could automatically save you around $150 in taxes without you having to lift a finger. If you are someone who itemizes deductions like mortgage interest, state and local taxes, or charitable giving, these changes still matter. Your itemized total has to be more than the new, higher standard deduction to be worth it. As that standard deduction number keeps climbing, fewer people will find it beneficial to itemize, which honestly simplifies the tax filing process for a lot of families. Let's quickly touch on a few other important updates. The alternative minimum tax and exemption is going up, which means fewer higher income households will get hit by it. The federal estate tax exclusion is rising to an incredible $15 million per person, so a married couple can pass on up to $30 million tax-free. The annual gift tax exclusion is staying at $19,000 per person. Other key changes include an increased limit for health flexible spending accounts (FSAs) up to $3,400, and a higher earned income tax credit (EITC), which provides a crucial boost for working families. A few things are staying put, though. The personal exemption remains at zero, the child tax credit is still $2,200 per child, and the SALT gap, which limits state and local tax deductions, moves up slightly. For most people, the big takeaway is that the 2026 brackets and deductions will likely mean you lines owe slightly less tax on the same income compared to last year. In an economy where everything feels more expensive, even a little bit of relief is a welcome sight. So, what should you do with all this information? First, once 2026 rolls around, take a look at your paycheck withholding. Your employer should update everything automatically, but it is always smart to use the IRS withholding calculator to double-check that you are not overpaying or underpaying throughout the year. Second, if you're self-employed or have a side hustle, make sure you adjust your estimated quarterly tax payments for 2026. Your projections might need a little tweak. This is also the perfect time to think about your retirement contributions. When tax brackets shift up, it can change the benefit you get from pre-tax contributions to a 401k or IRA. The IRS will likely announce higher retirement contribution limits for 2026 soon, giving you even more room to save tax efficiently. Finally, if you've had a major life event, getting married, having a baby, buying a house, or changing jobs, all these updates can interact in new ways. It's not just about which bracket you're in. It's about how all the pieces of your financial puzzle fit together. While these new numbers might seem small on paper, they can have a real impact. A few $100s saved here and there adds up, giving you more financial breathing room. My advice is always this: understanding taxes isn't about memorizing every number. It's about knowing how the system works so you can make it work for you. With the 2026 rules now set, you have a great opportunity to plan ahead. What do you think about these changes? Do they offer real relief, or just barely keep up with the cost of living? Let me know your thoughts down in the comments. I am really curious to hear how this affects you personally. And if you found this video helpful, please hit that like button and subscribe. I break down these updates to keep you informed and prepared without all the confusing jargon. At the end of the day, the goal is to keep as much of your hard-earned money as possible. Thanks for watching, and I'll see you in the next one.